I think there are a few things driving the rally in tech. I mean, one of them in particular is the extra liquidity we've had as the Treasury's drawn down the TGA. This is the balance with the Fed, which has basically offset the impact of QT. So at the margin, there's been a positive change in the liquidity environment, which I think has fueled a lot of that. And look, let's also remember, the markets were deeply bearish a couple of months ago. So a rally in equities has been the pain trade. It's been liquidity fueled. And of course, there's a bit of a frenzy around AI. That's the new buzzword. So look, I think this is probably a short-term phenomena. And I suspect this uptrend is nearing exhaustion.
I want to pick up on what you said about the March higher being a pain trade, which it absolutely feels like it has been. You talk to asset managers, and they've been pretty bearish throughout the year and have been waiting for the economy and the market to turn. It just hasn't happened yet. Have we seen capitulation among those bears, or are they still holding out?
Well, I think we're getting very close to capitulation if we're not there already, and that's showing up in all kinds of indicators, whether you look at the outstanding volume of call options on these stocks has now gone to very high levels, the kind of levels that would normally mark a local high in equities. Or you look at some of our proprietary indicators at Longview, we measure risk appetite. They're now pretty extreme. They tell you risk appetite's been persistently strong. It's overdone to the upside. So markets are overbought. They're massively pumped up. And interestingly, the language is starting to change. So the narrative is, well, these stocks should be in a bubble. Nvidia trading at 60 times earnings, that's justified. As soon as you start to see the narrative change, it's often coincident with a major local high in equities.
Harry, I want to pick you up on another thesis that you mentioned at the beginning, which is to do with the liquidity situation over the next couple of months. We know that the Treasury are planning on rebuilding their TGA reserves, and that's going to mean a ton of Treasury bill issuance in the front end of the curve. Many people are saying that could take liquidity away from other risky assets or even other more longer dated Treasury bonds. What, to your mind, is going to be the broader impact of the Treasury's desire to rebuild those reserves over the summer?
Yeah, well, I think you're right. I think it'll suck liquidity out and it'll be negative for risk assets. And I think it's one of the reasons why we're likely to see much weaker equity markets over the course of the next several months. I mean, what do Treasuries do in that environment? Our sense is probably we're due for a rally in Treasuries because they're now pretty much oversold on lots of measures, and I think they're due a bounce, but particularly if the macro environment continues to deteriorate, which it seems like it probably will. Money's far too tight. So, and the correlation between equities and bonds is changing, isn't it? We're starting to see it fall, and that's also very normal ahead of and into recessions. The bond equity correlation falls, equities sell off, bonds rally as we price in easing and so on. So I think the outlook for Treasuries is reasonably positive.
So it's positive for Treasuries. You sound pretty bearish on stocks. What is the best way to express your view on where markets are headed? How are you playing for this pullback?
Well, underweight U.S. equities, I think, is the right trade. This is the part of the market globally which is most frothy. You could argue some parts of Europe, maybe Japanese equities are a little bit frothy as well, but certainly this is where the excess has been building, not just in recent months, but in the last 10 years. It's where the excess in the global financial system has been funneled. And so, look, I think there's a large de-rating to come there. So that's one way of playing it. Overweight bonds, overweight credit, we're a little bit overweight cash. So we're pretty defensively positioned into today.